for life.
And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, alongside me as usual, CFP Allison DeBrill. Together we come to you live every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your personal financial situation, then this is your forum to discuss. We hope you jump on the phone lines, give us a call, 627-7979. No matter what Alice and I are talking about, if it's important to you, it's important to us, we'll get you right on air. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interests ahead of our own in any business dealing. And that's the way it should be when you work with a financial advisor. As a premier financial planning firm in Hampton Roads, we integrate expert investment management with comprehensive ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday, and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success. Because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it, and it is a choice. Because it takes some time, it takes some effort, it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give us a call, 627-7979, whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, mortgages, Social Security issues, retirement planning, retirement plans, 401ks, 403bs, estate planning, wills and trusts, all that and more falls under the umbrella of personal finance. We are here to discuss tonight, 627-7979. Good evening, Allison.
Good evening. I thought we would tackle taxes. Everyone loves taxes,
so much
right?
Fun. This is going to be crazy.
Not the angle you're thinking. We're not going to tackle the tax bill that's being, debated right now, but we will talk about some practical effects that taxes have on retirement. So, when you're a retiree, you have 401k plans, IRAs, all your retirement accounts, and there are some tax traps that you can fall into, or just some situations that might take retirees by surprise. Because if you are, I was going to say a retiree, but really if you're just anyone and you're not completely up to speed on all of the ins and outs of the tax code, I don't think anyone would be surprised.
Right, and who really is?
Exactly.
No one. That's who is.
Right.
Zero people.
Zero. So we're at least going to hit some high points of things that you should be on the lookout for when doing your retirement planning and when in retirement. We can kind of talk about the role of taxes and how they may come into play and impact some of your decisions. But really the first point we want to tackle is what are taxes going to look like in retirement? Many people ask the question, okay, are my taxes going to be higher and lower? And like all good financial planning questions, the answer is, it depends.
Mm-hmm.
It really depends. I mean, first and foremost, it depends on tax rates. So we don't ever know what tax rates are going to be in the future. And we, as a firm, don't make a point of trying to predict or forecast that. We work with current tax law to the best of our abilities. So you don't know what tax rates are going to be in retirement, but typically you will be in a lower tax rate in retirement than you were when you were working, but it might not be as dramatic of a change as you would expect because you won't have lots of itemized deductions. I mean, most people now, actually, whether you're working or retired, take the standard deduction.
About 90%.
Mm-hmm. So, don't bank on having a lot of big tax deductions in retirement. And then, what do you want to do in retirement? Most people want to finally do all the things that they have put off for a lifetime while they were working and saving. So you want to have fun and use the money that you saved. And there are tax implications when you start using retirement savings, and that's what we'll talk about tonight.
Yeah, so if the money's coming out of pre-tax savings vehicles like your 401k plan or your TSP or your 403b plan, or your simple IRA, then the money that comes out of those traditional large retirement plans is going to come out as ordinary income. So just like you were getting ordinary income, is paycheck income. So if you were making $100,000 in salary before your retirement and you need to withdraw $100,000 from your 401k or IRA retirement fund, then you're going to pay tax on that same $100,000 just as if you got it through a paycheck.
Mm-hmm. You may have different buckets to pull from. You may have some 401k retirement tax deferred accounts. You may have some regular brokerage savings that then would just be subject to capital gains tax on any gain that you realize when you decide to sell the investment and use the money for spending. Or you may have Roth money, which, as long as done properly, would come out tax-free. So you may have some options and some ability to strategize from a tax perspective about how to start withdrawing from your nest egg in retirement.
And I should point out some philosophy and strategy here from our perspective. Reducing your tax bill, legally reducing your tax bill, is important to your own financial health. And where opportunity presents itself, you should attempt to do that. But that activity should really be secondary to the overall activity, the primary objective of trying to maximize your overall net worth, growing your wealth over time. So many times when we sit down with new clients, one of their primary objective might be to reduce or try to eliminate their tax bill. Well, under the current tax regulation, you just can't do that without giving away all your money or losing all your money or some other detriment to your net worth. So don't let the tax tail wag the dog, okay? It's important to try to lower your taxes, but don't do that at the expense of your overall the growth of your overall net worth. That's what's most important. And unfortunately, the way the current tax code is, the more you make, the more they're going to take. The more, when you turn a profit on investment, you're going to have to pay some tax. But where we can move some things around, where we can use some advanced tax planning, then we're going to try to do that, because most people taxes make up if not the largest, one of the top 3 expense line items in a household.
Yeah, that's a good point. So we're talking about the role of taxes in retirement and retirement planning right now, but your point is a really good one about being proactive. Where you can do a lot of your tax planning for retirement is actually in the accumulation phase, actually making sure that you're creating different buckets that have varied tax treatment so that you have a lot of flexibility and can be very strategic in retirement about where you're pulling your income from.
Yeah, the time to do tax planning is not April 14th, the day before taxes are due.
It's not even before December or after December 31st.
Or December 31st on the last day of the year in which your taxes get calculated on. Tax planning for that year starts on January 1, and you work it through over the course of the year. Good proactive tax planning over your lifetime starts the moment you start getting a paycheck and looking ahead into the future and finding out what the best tax-preferred investment savings vehicles are.
Mm-hmm. So we're talking about the role of taxes in retirement and in retirement planning. And something that seems to surprise a lot of people that we talk to is the fact that Social Security can be and often is taxable. Mm-hmm. Many people don't realize that if you have a certain amount of income, and we can talk about the specifics, but if you have a certain amount of income, part of your Social Security benefit is taxable. So you look at your adjusted gross income and you add half of your Social Security benefit to that. And that will give you what they call provisional income. You don't have to remember any of this. I'm just kind of breaking down how they calculate it. So all of your adjusted gross income and then half of your Social Security benefit. And if it is more than $44,000 a year for married filing joint couples, then 85% of your Social Security benefit will be taxable. If it's more than $34,000 for single filers, same thing. 85% of your Social Security benefit is taxable. Could they make that more complicated? I don't know.
Yes, they could. Don't give them any ideas.
It's a lot, but your takeaway is that your Social Security benefit could be subject to taxes. And here is another key point that many people don't realize. When you claim Social Security, they don't withhold taxes.
Automatically.
It's not even an option when you claim. You actually have to file a separate form to have federal taxes withheld from your Social Security benefit. So you can imagine how many people don't realize it's taxable and don't realize there are no taxes being withheld, and that can cause you some problems around tax time. So make sure you elect federal withholding on your Social Security benefit as appropriate.
All right, talks about retirement tax planning tonight. If you want to jump in on this topic or talk about anything having to do with your personal financial situation, jump on the phone lines, give us a call, 627-7979. She's Allison. I'm Kevin. You're listening to Dollars and Common Sense on AM 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. Alongside certified financial planner Allison DeBrill, I'm CFP Kevin Zivna. We're from Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with comprehensive ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. 627-7979 if you want to jump on the phone lines and jump into the conversation on retirement-specific taxes and tax planning.
We've been talking about the role of taxes in retirement. We're going through some things to be aware of that might not be commonly known, and some pitfalls and traps just to watch out for. So we talked about tax rates in retirement. While you may expect them to be lower, there are situations where your taxes may not be lower because of tax rates or because of the way your nest egg or your retirement income is structured. And the fact that Social Security is taxable for many people. Once you have a certain amount of adjusted gross income, that will cause your Social Security benefit to be taxable. So you want to be on the lookout for that, and you want to make sure you elect withholding on your Social Security benefits.
Unless you want to get surprised by a tax bill, or some people pay quarterly estimated taxes because they haven't withheld enough from the Social Security benefit.
You can do that too. So we talked about having different buckets of savings in retirement to have some flexibility for tax purposes. And one of the questions we often get as people are transitioning to retirement or in retirement is, can I still contribute to my IRA? So they may have been making tax deductible contributions while working, or they just may have extra cash flow and they may want to make IRA contributions. Well, up until a couple of years ago, you could not contribute to a traditional IRA after you turned 70 and a half. That was just a solid cutoff. But with the Secure Act of 2019, it lifted that age limit. So now anyone of any age can contribute to a traditional IRA, as long as you have earned income. So that's the second piece of the equation that many people they miss. They think, well, I've got my pension and I'm, earning my income. I have income. Can I contribute? No, it has to be earned income. It has to be W-2 or it can be business income, but it does have to be earned and not pension or retirement income.
Yeah, so for most people, that's going to be income from wages or profit from a business that you are an owner of. But that most people for pensions and Social Security, interest, bank interest, dividends from mutual funds, capital gains distributions, none of that counts. It needs to be on. Oh, I used to know it was a line on the tax form.
They've changed all that. I know. I don't like it.
I used to know what line that box was on. I forgot, but
one.
It's right. It's right near the top. It's in the top 5 boxes. Let's put it that way.
Yeah. But if you have earned income, you can contribute up to $6,000 a year, or anyone over the age of 50 can contribute an extra $1,000 for a total of $7,000 a year. And as long as you meet certain income requirements, you can take a tax deduction for contributions that you put into a traditional IRA. So something you can do in your later years, but you have to have the earned income.
All right, got a caller on the line. We have Jim in Newport News. Good evening, Jim. You're on Dollars and Common Sense.
Hey, guys. My question is, I'm retired military, and I have a military TSP that's basically traditional before taxes, contributions, and I'm looking at transferring that to a traditional IRA and then over time converting it. My question is, should I move all of that money out of the TSP into an IRA at one time, or do you think it'd be better to do a chunk of it a year? Because I'm not going to convert it all in 1 year. I've got to do it over time to keep my tax rates a little in the lower bracket is my idea. Over.
Yeah.
How old are you, Jim?
I'm coming up on 60.
60.
You did say you were retired. Was that correct, Jim?
Yes, retired military.
Yeah. So the act of transferring the TSP money into a traditional IRA, which is step number 1, that is a non-taxable event. You can do that at any time, and there will be no tax implications in that maneuver, done properly, of course. And we generally recommend that most people should make that maneuver. You have more control over the investments in an IRA account than you do in a TSP. You have more control over the custodian or the bank or whoever you work with. They're easy to get access to. So generally we recommend that people do that when they separate from service from the military or federal government with the TSP. Now, step number 2 then is taking the money. So you could convert 100% of everything you got in your TSP to that traditional
rollover,
rollover into the traditional IRA. And then step number 2 is to convert from the traditional IRA to a Roth. And the way you were describing it is that wisely you were looking to do it in segmented amounts that would prevent you from getting into too high of a tax bracket, because everything that comes out of that traditional and converted to Roth is going to be ordinary income. That's when you're going to have to pay your taxes. So you do want to manage your tax brackets there, so you most likely don't want to do it all at once. Run yourself all the way up the tax ladder in one particular year, and then you aren't doing it as tax efficiently as you otherwise probably could. So the strategy is a good one. You just have to do it in a couple phases.
Okay.
Jim, tell me, what is your goal with the Roth conversions? What's your thought process there?
My thought process is I'm betting that my taxes are going to be higher in retirement than they are right now, because the tax brackets are lower from now till 25. Again, that's assuming that it doesn't get changed and assuming that the backdoor Roth stays in effect, and I know Congress is looking at changing that. But my idea is if I do it now, overall I will pay less taxes than if I wait till taking it out in retirement, because I think I'm going to pay more, because I think tax rates are going to go up.
Yeah. Okay. And it is a common strategy that you see being practiced now.
All right, and we'll probably have some more information to guide you on that decision, Jim, when we come back from this break. We got to pause here for the news a little bit. If you'd like, you can stay on the line, or if not, Allison and I will take it from here. And thanks for your call. All right, we're going to step out, take that short break. We're going to be right back in a few minutes. If you want to jump in on the conversation, give us a call on the studio line, 627-7979. She's Allison. I'm Kevin. You're listening to Dollars and Common Sense on AM 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. Alongside certified financial planner Allison DeBrill, I'm CFP Kevin Zivna. We're from Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with comprehensive, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. You can also sign up for a free quarterly newsletter or request an information packet to find out what it's like to work with us at wealthwayadvisors.com. Just go to the contact page, put your name and address in there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you that information that you request. All right, 627-7979 to jump on the phone lines. And tonight we're talking about retirement tax planning. So if you have any questions or comments on that, or anything having to do with your financial situation, give us a call, 627-7979. I want to follow up a little bit on Jim's question because it was a good one, and we're hearing it more and more these days with people concerned about potentially raising tax rates and tax brackets. And so we're hearing a lot more people who want to convert traditional IRAs into Roth IRAs, which can be a viable strategy, but that conversion process is a taxable event. So you have to proceed with caution. And we have learned some interesting things through study and analysis about this technique.
Yes, we've done a lot of research about this recently, because the conventional wisdom out there is if you retire somewhat early and you have some years where you have no income, no large pension, you haven't claimed Social Security, and your required minimum distributions haven't kicked in yet, then there could be some opportunity to convert some portion of your pre-tax money into tax-free money at low tax rates. But when we try to put this into practice, because you are essentially prepaying your taxes, it takes you a certain amount of time to break even from doing that. So you take money out of the traditional IRA, pay your taxes, and then it does grow tax-free going forward. But we're not seeing that break-even point until very late 80s, sometimes almost 90. So while it can save you $1 million, I've seen a couple $1 million in taxes over your lifetime, you may not actually really see the benefit of that. And so we might recommend this strategy for clients that feel very strongly about leaving a tax-free asset to their heirs. But if you're doing it for your benefit, just know that it takes quite a while for you to make up prepaying those taxes. And that is even considering the tax loss sunsets that are scheduled for 2026.
So not always a slam dunk strategy. It helps to have a long time horizon. And I guess you could say it would help if future tax rates do jump up considerably.
It'd have to be considerable, yes.
It wouldn't be a help overall in society, but it would help in this
We're not wishing for that.
Right. But for this one particular strategy to work, a big jump up in tax brackets, tax rates, would then make the numbers more favorable by converting today.
Right.
All right. Okay, Brian in Virginia Beach, thanks for holding patiently. You are on Dollars and Common Sense.
Hey, is that me?
Yes, that's you.
Hey, actually, my name's Brent.
Oh, Brent,
Brent.
sorry.
Yeah, that's all good. So I got a quick question. So this new Cash App thing, like the peer-to-peer sharing, I know y'all are like way smarter than me about finances and stuff, but like, so I run 2 different businesses right now. And a lot of times, like my guys, like, because I only got the 2, debit cards. And sometimes, like, my guys, like, hey, they need money and everything. And I'm like, cool, what's it cost at, this site where they're picking up like $500-600 worth of material. And I just send them the money on Cash App because it's so easy just to do the share-to-share thing. I know with the new tax law, basically, like, they're going to start taxing us on that. So is there some kind of way that, like, I can get around that? Or, I mean, not around it, but you know what I'm saying? It's like, I'm just trying to make sure I'm not going to, like, get my guys in trouble because if they need money, I need to send them the money.
I see.
So are we talking about a money transfer technology like PayPal or Venmo,
Venmo, yeah,
and
yeah.
and
Yeah,
Cash App?
yeah,
is
basically.
Yeah.
And
you're saying that you think that there's going to be taxation on the transfer?
I think because that new law that I've been hearing about anything, like, it's over like $20,000 or something, or like anything more than $600 on transactions,
yeah.
it's going to get taxed on.
Well,
I'm just worried about that because I mean I'm just a small little time business owner.
So it sounds like you're just trying to find an easy way to facilitate a transaction on your behalf. Like you're sending, you said your guy's an employee to go purchase supplies on your behalf, and you've been doing that using Cash App.
Yes, because I only have like 2 business cards. And
Right.
I have one, and my business partner has the other.
Yeah. Yeah, and I can see what you're saying, that the IRS would look at that as not you purchasing supplies. They look at that as you sending money to another person, to an employee, essentially.
Yes.
Yeah.
Well, I don't know enough about the proposed law
I don't either, no.
to really give you much guidance there, Brent. It is a common practice in business to allow employees to have purchasing power, whether that's a corporate credit card, whether it's the company checkbook, whether you give them cash and a voucher system. So I can see in today's modern world where this might look a little like a potential, like it's a way you could potentially pay your employees without withholding federal, state taxes, Social Security taxes, all that. But as long as the documentation in your books were in order, I don't see how that could be subject to extra taxation.
Well, I mean, I was just worried because don't get me wrong, I got all my guys on payroll, and like I said, I only got 2 cards, but I got like 6 employees. So, and I'm running around between like 2 to 3 different job sites, and I can't always give them the card. So sometimes, like, I have the card because I'm buying materials, and then my other business partner has his card because he's buying materials because we're on 2 different job sites. And I'm just trying to, like, hey, I'd love to give them the card, but apparently the way Cash App's working now is, and I don't really know. I'm just trying to get a little bit of financial advice because I'm kind of new to, like, running 2 different businesses right now.
Yeah.
And I'm looking for any kind of help. I mean, I'm some construction worker,
Yeah.
I'm not smart like anyway on financial stuff. So
Well,
I'm just trying not to, at the end of the year, I'm just trying not to have the IRS be like, hey, guess what? You owe us everything you just made last year. And hey, congratulations. You got $0.
Yeah, I mean, I can see how that type of a transaction could be misconstrued. It might be worth talking to your vendors to see if you could set up some other pay, like a account with them to make it easier for you to facilitate those transactions without you having to be there. Or maybe talking to your bookkeeper or CPA about the best way to handle that, because without knowing too much about what's in the current proposal, since it's all subject to change.
Change, it's not law.
I can see how that could be slightly misconstrued and make your bookkeeping more difficult.
Right, but I would
Yeah.
expect that as long as the books were in order and you can justify that the payment was transferred, the money was transferred for payment of materials, that's a fair and legitimate, transaction that should not, in my mind, pose any additional excise tax.
Okay, that makes me feel a little bit better because, like I said, like I pay a bookkeeper to do all my stuff, and she's very good at what she does. But I'm just worried about sometimes when I transfer these guys, like, hey, I've got a lot of vendors and we have accounts with them, but sometimes like I just have to pay the cash and the money up front. And, sometimes like, oh, my account's maxed out. So it's like, hey, cool. Well, I'll just give you the cash, but I just don't want my employees to get screwed at the end of the year, be like, oh, well, they sent me $10,000.
Exactly.
Yeah, it's all business stuff.
Brent, when you
So,
transfer that money, then it goes on to like their app, and then that app is then used at the business. The business then accepts it, or they have to go physically get cash from a place.
So I have most of my guys set up on Cash App because it's honestly the quickest way to transfer money left and right. Because I got all my employees Cash App cards because I could take my business account and transfer
cards.
money instantly.
All right.
Right
gotcha.
over to them.
Yeah. Okay.
So
I
it's
got
like,
it.
hey, we're
Gotcha.
going to this, account. Oh, I need to get like 3 or 4 pallets worth of material.
Yeah.
Okay, cool. It's going to be like, $4,000.
Right.
Well, cool. Here you go. Here's the money. Use the Cash App card
Gotcha.
that, I bought you, but it's on you. But it's like, hey.
Yeah, but it
It's
looks
just-
like
it's easier than
compensation.
getting, like-
Yeah. Okay. Yeah.
Yeah.
I got a pretty good
That's what I'm worried
picture of it
about.
now. No, I mean, the employee who uses the Cash App card gets a receipt, right, from Lowe's or Home
Yeah.
Depot or Joe's Plumbing, and brings that back to your bookkeeper. You match the Cash App transaction up with a receipt for legitimate work materials. I mean, that's I don't know what extra tax that could provide unless people are not doing their books properly.
I was just worried about it because I keep hearing on AM radio about the new peer-to-peer sharing thing, and they're going to try to tax people. So it's just I'm just trying to like feel better,
Right.
a little bit because my guys are compensated very well, and I bought them all the Cash App cards, and I only use it for business because, like I said, I can't give like 5 employees all business cards.
Right. Well, until the law gets finalized, Brent, we're all kind of speculating at this point, but it sounds like what you're doing is legitimate types of transactions, and at least at this point, I'll try to put your mind at ease that you're not going to have to worry about that too much. If more information comes around about this, we can follow up with another show. So thanks for that call. We appreciate it. We're going to run up to Newport News and speak with Edmund. Good evening, Edmund. You're on Dollars and Common Sense.
Hey, how you guys doing?
We're doing great. Thanks for the call.
Thank you. I'm enjoying the show. I had a question about asset allocation for short-term money. I know longer term, 7 years, 10 years or more, yes, you want to be in stocks. We have some money set aside for early retirement. My wife and I are 51, and we have a good chunk set aside until 60 when we start drawing on our Roths. What's a good allocation, or how should the money be allocated when you only have, 1 to 9 years that the money's going to be used?
All right, well, a little bit of clarification on that. First of all, I guess we would say 9 years is not short term. 1 year is short term. Medium term, so short term is we would probably define as 1 to 3 years. Medium term, 3 to 7, 8 years. Anything longer than 7 or 8 years, long term. The more money gets pushed out to the long term bucket, the higher the probability that a good investment program in like equities, stocks, will yield you a higher result. But so you're kind of kind of spanning the spectrum there because you have about 9 years to go. So first of all, you do need to have short-term amount of cash on hand. Normally, the rule of thumb, 3 to 6 months for emergency purposes. But one of the strategies we like to use with our clients who are in the distribution phase of their lives, essentially retirement, and they're starting to live off their nest egg, is to build up that bank account even further, where we would keep upwards of maybe a year to upwards of 2 years in just cash sitting in a bank, money market account. Right now it's earning nothing, but it's very accessible, it's very liquid, and there's going to be no deviation in value. And yes, you could maybe squeak out a few more bucks by getting CDs, a 6-month CD or 12-month CD. But probably, we would say that your short-term cash probably only needs to be up to 2 years if you do the rest of your investment process right. So how does that mesh with what you're thinking right now?
That's helpful. So then we're going to actually be drawing on the money. So we have approximately $500,000, and we're going to draw on it $50,000 a year for the next 10 years. So I get it. Keep 2 years cash. That's $100,000. My issue is, what do we do with the remaining $400,000?
Yeah. So here's a suggestion for you. So the rest of the $400,000 goes into a well-managed, properly diversified, growth-oriented investment portfolio in a brokerage type of account. So it's not in retirement funds accounts like an IRA. So you can access it below age 59 and a half without penalty. And then so each year you sort of roll. You draw out $50,000 of your bank account in 1 year and sell off $50,000 from that investment account and then move it into your bank account. So you're always kind of replenishing that bank account with 1 to 2 years worth of cash. And yes, it's possible that in some years we could have negative returns, and that you could be selling some stocks while they're in a down position. But because you're only piecemealing the money out of the account, you're buying yourself time, that long time horizon, to only take out smaller chunks than the whole amount. And so by doing it that way, you maintain the high probability of having more money through equities and being able to have the certainty and safety and security of having easy and ready cash flow at the same time. Does that make sense?
Yes, that's very helpful. Can you give a range of what might be appropriate amount of stocks versus bonds? Are we talking 50 to 75% equity versus bonds, or 50-50? I mean, obviously it depends on your risk tolerance, but what's a range of something that would be appropriate?
Yeah, well, I'm not going to give you any specific advice because that wouldn't be proper given the format, the radio format that we're on, and we would need to know a lot more about you and your financial situation to do that. But I will say this generally, that we believe that there's more risk in bonds right now today than there are in stocks, and that the risk of a lower rate of return in bonds is greater than there is in stocks over the next at least 5 to 10 year period. And that's because we are in a rock bottom interest rate environment, and when rates start to tick up, bond values are going to decline. So those old models of 50-50 portfolios or 60-40, we do not believe in them. We do not think they're appropriate today. And even clients who we have in our 70s and 80s and living off their nest egg, while we haven't abandoned bonds, we have dramatically underweighted that allocation compared to historical norms.
That's very helpful. Thank you guys very much.
All right, Edmund, thanks for the call. We appreciate it. We got to run, take a quick break. We're going to be right back after these messages. 627-7979. She's Allison. I'm Kevin. You're listening to Dollars and Common Sense on AM 790 WNIS. And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. Alongside certified financial planner Allison DeBrill, I'm CFP Kevin Zivna. We're from Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with comprehensive ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. You can also request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the contact page, put in the appropriate information, and select from the drop-down menu which of those items you'd like to receive, and we'll get them out later on to you later on in the week. Want to remind everybody, our next show will be in 2 weeks on Tuesday, October 12th at 6 p.m. as usual, or you might hear us as a rebroadcast on this Saturday morning. If you do, we are not live on Saturday. We are live every second and fourth Tuesday. And if you can't catch us live on Tuesdays or rebroadcast on Saturdays, you can get this show as a podcast and take us with you wherever you go.
Yes, search for Dollars and Common Sense wherever you get your podcasts. Click subscribe and listen anytime, anywhere.
Have just a couple minutes left in the show, so I want to wrap up a few thoughts on retirement tax planning.
Yeah, we've been talking about the role of taxes in retirement and some things that people aren't aware of. The fact that some of your Social Security might be taxable, and the fact that your nest egg, your different account types in your nest egg may have different tax treatment. So being aware that money that comes out of your 401k, your IRAs, that's all taxed as ordinary income and is going to push you up those tax brackets. But if you have Roth money, that will come tax-free. And we did have a caller that asked about rolling over from a 401k or retirement plan into an IRA. That's a tax-free movement if done properly, trustee to trustee, and we do almost always recommend consolidating so that you have more control, visibility over those investments, and a cohesive retirement withdrawal strategy.
Yeah, you want to simplify your financial affairs as much as possible as you transition into retirement. Very rarely is there any benefit in excess complexity, and there should be a real good reason in order to have that. So consolidate all those retirement accounts, the TSP, the 401k, the 403b.
The TIA.
Yeah,
that
the
one
TIA
too.
into an IRA. All right, we're going to be back in 2 weeks on Tuesday, October 12th. Until then, for certified financial planner Allison DeBrill, I'm CFP Kevin Zivna. You've been listening to Dollars and Common Sense on AM 790 WNIS. The preceding program was sponsored and paid for